What if your investment program fails? Warren Buffett once said that the first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. And that's all the rules there are. Now, every investor's nightmare is completely losing all their money. Now, this is actually kind of hard to do unless you are aping your money away. Still, this doesn't mean that your money is safe when it's invested. Actually, it's far from safe. And believe it or not, this is actually a great thing because without any risk, there is no excess return. But the question still remains, is protecting your portfolio a worthwhile endeavor? One of the most unfortunate things about finance is that it's an observational science, meaning you can only deduce the future based on past data. In Fooled by Randomness, Taleb says that finance is one of the rare areas of investigation where we have plenty of information in the form of abundant price series, but no ability to conduct experiments, as in, say, physics. This dependence on past data brings about its salient defects. Remember the saying, past performance does not guarantee future returns? If one were to take this to its most logical conclusion, then we could say that the markets are just a complete random walk. Now, we know that this is not necessarily the case, at least historically, because when you buy stocks, you should be compensated for taking a certain amount of risk. And if you stack factors on top, then you should be compensated for taking that risk. However, these returns follow from a certain level of risk taking. And in the possible outcomes is a small sliver of complete or near total ruin. Now, when I say total ruin, it may not mean that your portfolio might go to zero, unless, of course, the world ends, but there is a chance of heavy losses that psychologically might completely ruin you because you might not want to invest anymore. It might not be a fun game to play after a certain level of drawdowns. So who should protect their portfolio? Well, I asked this question to Alpha Architect President Ryan Kirlin. Here's what he said.
The person or people that need to protect their portfolio the most are those in or nearing retirement. And I'll use a simple example for why that is the case. If you are an accumulator, right, you're earning money still, you're adding to your portfolio every 2 weeks, every month, every year, whatever, your best case scenario would be that the stock market goes down 99% tomorrow and stays down for the entire time until you retire, let's say 30 years from now. And then the day you retire, the stock market goes up 3,000% and voila, you've made 10% annualized returns for the entire 30-year time period. Great. For somebody that's about to hit retirement, that's the worst case scenario, right? The day you retire, the next day the stock market goes down 99%. Well, you need to pay your bills, you need to pay your rent, your mortgage, your electric, whatever it may be. It doesn't matter what the stock market does in a year, in 2 years, you're out of the game. You've lost your money. Definitely most important is people in or near retirement.
Imagine you're a turkey, a statistician turkey, and you are living in a farm. And you've been gathering data for the past 1,000 days and come to the conclusion that there is no evidence that the turkey population is at any level of risk. In fact, with great statistical significance, you conclude that the farmer is a good person. The farmer has been feeding you and your peers, and you're nothing but a happy turkey. Unfortunately for you, you conducted this survey the day before Thanksgiving, and the next day, you're laying on the farmer's table, but this time, you look delicious. This is known as the turkey problem, and it was first presented by Abraham Wald, who in World War II was trying to explain that when looking at surviving planes from war, one should not look at the areas that were hit and trying to protect those. The reason being is that these planes survived. Therefore, they were not shot at the points that would have made them crash. So his conclusion was protect the areas that were not shot at, since these were survivors. And this is a really good explanation for survivorship bias. Now, if you're standing here today or sitting down watching this video, in one way, you're a survivor. You've invested your money in the stock market and things have gone relatively well to a certain extent. That doesn't mean that this data that you have is what the future will necessarily look like. So if you want to protect your portfolio, there's actually a couple ways of doing this, and it all depends on the path. One of the ways to protect your portfolio is by using trend following, where basically if an asset is going up, You stay invested, you are buying, but if an asset starts going down, you start selling. This is done by looking at a set of rules that look at price action history. And you have to follow these rules. It's not as easy as just looking at a graph, squinting really hard and trying to figure out whether the thing is going up or down. And trend following has the potential of giving you similar returns to buy and hold, while at the same time giving you shallower drawdowns and likely lower volatility. And this sounds too good to be true. And that's because it is kind of too good to be true. The problem with trend following is, though it has the potential to give you that return profile, at the same time, it's one of the hardest things to implement. And that's because when the market goes roaring and you're in cash, well, you're gonna feel like an idiot. This is what we call a whipsaw. And truly, there's so many whipsaws an investor can take and bear before they give up on the program. Irrespective of whether or not the investor can stick with the strategy or not, if a drawdown comes at a slow enough pace, trend following has the potential to get you out in time. These slow enough drawdowns usually are tied to economic news, both because investors are slow to react to these news and because the data itself takes time to reveal itself. However, if a drawdown comes at a fast pace, trend following might not keep up. For that, you need a different tool. If a crash comes too fast for trend following, you are going to need something that resembles insurance. And for that, we have tail hedging. Now, tail hedging is done various different manners, but one of the most well-known ways of doing this is by buying put options. And put options are contracts that give the buyer the right, but not the obligation, to sell an underlying at a pre-specified price on or by a pre-specified date. And if you buy an out-of-the-money put, meaning the strike price is really, really far out of the money, well, this is likely not going to pay off, but in case it does, it should pay off big. Now, if this sounds too complicated for you, I have a video that goes over these dynamics a little bit more in depth. Now, these fast crashes tend to happen because of actual existential and structural problems in the world. Because of this, tail hedging is one of the best tools you can use in order to profit from that. Hopefully what this ends up doing is muting portfolio level losses. Because the benefits of these exposures can be so large, put buying is actually notoriously expensive, and it can hurt portfolio level returns since you're constantly burning these premiums and causing a drag in your portfolio. This is especially true when volatility is high and these premiums do not have the chance to give you a nice payoff. So in order to tail hedge, investors really need to think about how to reduce this portfolio drag. So there you have it. If you're trying to protect your portfolio, you have trend and tail hedging at your disposal, and it really depends on how the market moves to say which of these two is the one you should have. But if you want to have a really robust portfolio, then including both might be probably the most robust of solutions. And like most investment strategies, if you want to reap the rewards, you need a lot of education and a lot of discipline in order to stick with your investment program. That's it for today. Thank you so much for watching. Make sure you subscribe, like, share this video with a friend that would find this information helpful. If you want more content like this, you can head to alphaarchitect.com/subscribe, and there make sure to subscribe to the blog. And lastly, make sure to follow me on Instagram and TikTok at Coffee Hour with Jose. I'll see you next time.